A hot topic when it comes to retirement investing and even retirement income planning is the whole area of, we call it sequence of returns risk. Now, I learned about this risk back in the mid-1990s. It started as a debate over the book Equities for the Long Run by Bert Siegel. Now, clearly, markets have done very well since then, but the debate still persists. So let's look at sequence of return risk and see what it really is. We start this whole discussion again by going back and taking a look at returns. A basic return is the average annual return. Now, as I say, this is the set of historic annual returns looking at what they are on any given year. And we like to look at the noise around them. So let's take a look at the last 75 years of returns. And you see this kind of cloud has developed. The average is about 12%, but the standard deviation is 17 percentage points. So, you have this really wide range. And returns can be great one year, and they can be horrible the next year. So, yeah, that means that this equity investing for 1 year holding period can be pretty scary. So let's go back and think about returns on a little bit of a longer time period. So when we want to measure a longer time period, we use what we call time-weighted average returns. This is if we held a portfolio for 2, 3, 10, 20 years, what would be the average annualized rate of return? We also think of this as the compound average growth rate. So think of it in terms of, assume I've got a portfolio, and in the first year, it's down 10%. The second year, it's up 10%. So if I was just thinking this on an arithmetic average, minus 10 plus 10, my average return would be 0. But if I'm thinking about it on a geometric basis, or if I actually had dollars invested, then in my first year, if I had $100 and my portfolio was down 10%, I'm down to $90. And then the second year, I'm up 10%. Now my portfolio is worth $99, not $100. So my average return in that case was minus 0.5%. So you can see where the problems start to develop. One of the things that we find is with the geometric average, it's always going to be a little bit lower than the arithmetic average. A third case is when we start to introduce cash flows in and out. The first two numbers are assuming a buy-hold portfolio. The third, by introducing cash flows that we're bringing back in. And we covered that when you learned in 591 with time value of money, you learned about the internal rate of return. So you already know how to calculate it, at least on your calculator, and you know that there are other functions. But it is a far more complex way of thinking about the problem. So let's take a look at this real-world situation, actual returns from the last 75 years, and make a couple of other assumptions. The first assumption is let's hold this basket of equities for 5 years. Again, it's the S&P 500, and we're reinvesting just the dividends. So I hold it for 5 years, and what you start to see is the standard deviation has gone from 17% to 7.7%. We can still have some negative periods, especially in the more recent 15 years when we had some really lousy returns, but you see that those losses, the annual losses, are much lower than they were if we take a look at just any 1 year. At 10 years, now you start to see a very interesting pattern start to develop. It's like a cyclical pattern of returns. And over the last few years, we've been a little bit below average. But again, you see that standard deviation of the annualized returns continues to shrink. Okay, those are the bars around where the average returns are running. And the minimum return is continuing to grow up. So let's take a look at 20 and 30 years. Now this is where it becomes very interesting. On the far left of the 20-year holding period, this is coming right out of the Depression. So this was the worst period, even worse than we've experienced over the last 15 years of the markets. But you still had positive returns. If you bought a portfolio in 1926 or 1927 and you held it in those horrible years through the 30s until the 40s, you still ended up with a positive return over time. And for every other period, if you held it for 24 years, your average annual rate would have still been 11.3%. How about for 30 years? Now we really see something interesting. Those returns continue to flatten and flatten, to converge, okay? More and more towards, we always use this hypothetical equity return rate of 12%. That's where it kind of comes from, is if we buy a portfolio and we just hold it. We don't do anything with the equities. Over time, you start to see we get really steady returns over time without a lot of variability around it. In essence, what we can see from this is that by allowing time to work, by allowing the good years to offset the bad years, you start to get some pretty good returns out of the equity market. The key is time. Let's take a different look at this by looking over the last 30 years again. This is something that's pretty fresh in our minds. So I start to look at this portfolio in 1988, and I held it till 2017. Okay, so that includes some really bad periods, at 2000 to 2002. You can see that we had 3 years in a row of negative returns. Now, again, with compound average growth rate, the geometric returns, you can see how that really hurts the total value of the portfolio. We also had that minus 38%, minus 37% in 2008. They all have a significant impact. Still, the average annual return was 12%. The standard deviation was still plus or minus 17%. The only thing that was impacted was a little bit lower compound average growth rate. But it's still pretty damn good at almost 10.7% a year annualized. So what I did is I took those same numbers, and in the middle and over on the right, I sorted them. I sorted them in the middle by going from worst to best. And then on the right, I went from best to worst. And what's fascinating is if you take a look at the bottom, we end up with still the very same numbers. The average return in every case was 12.1%, and the compound average growth rate was 10.65%. The only thing that changes is how the returns got there. And that's what I'm showing in this picture. So I'm assuming, let's say we held $50,000. We put $50,000 into a portfolio at the end of 1987. We reinvested the dividends and just let it go. So that in our base case, with the actual numbers, now I'm assuming no transactions costs or fees, but you would have $1.1 million at the end of last year, 2017. But look at the difference in running from worst to best or best to worst. The yellow line, best to worst, you saw that the portfolio grew to well over $2.5 million by 2008. And then when it ran into the negative returns, the portfolio value plummeted, but it still ends up at $1.1 million. If we look at the ascending, where the portfolio value was returns were horrible, you can see that that portfolio doesn't do much of anything. But there wasn't a lot of value there. There wasn't a lot of money invested to begin with on the early days when the portfolio was so poor, and we had to wait for time to work its magic. But again, it does. So that by the end of 2017, that portfolio, again, is worth $1.1 million. Now, as I said before, the key to doing all of this was that I didn't have any cash flows in or out. And remember, when I was talking about calculating returns, when you introduce cash flows, you introduce a lot of complexity to the returns. You also introduce a lot of complexity to the real world. Okay? So, we always talk about this magic 4% solution, and I'll talk about where that comes from in a minute. But assume we take 4% out of the portfolio at the beginning of year one, okay? And then we grow those withdrawals every year by the inflation rate. So you can see on the far left, we have this portfolio, it's worth $50,000. We take out $2,000 at the beginning of 1988, and then we let the returns develop on the balance. And we do that for every subsequent year. So that by 2017, we're withdrawing $4,000. But look at that. The portfolio has grown to $600,000. In essence, you can have lots of margin there in a more normal period for the client to actually occasionally bump up that withdrawal rate and then start all over again, okay? Assuming that things work normally. But we're taking cash out again. This is like we're introducing a 4% loss on day one every year, okay? So when we do it in that period when the portfolio returns are negative, I started off, I had $50,000, and then I took out $2,000, and then I had a terrible loss. Now I'm down to $30,000, and I take out $2,100, and now I have another loss. And now I'm down to $21,000, and you can see how the problem develops is I'm still taking out this this $22,000. By the seventh year, I'm taking out $2,500. And my portfolio by that point is worth only $6,000. So you can see what has happened is even though I might start to get some positive years coming in, I've run out of my negative years, I'm taking out so much principal, I can't grow the portfolio anymore. So that by the end of year 10, I'm out of money. I've run out. Now, I don't run into any problem like that when I have really good returns to begin with. So this is really what you're seeing over here on the right is when I did not have any cash flows with the red line on the bottom, time was allowed to do its magic and finally bring that total portfolio value up to $1.1 million. But when I took money out, time becomes kind of a moot issue. And that's the problem. So where do we get this 4% value? Well, William Bengen in the 1990s was always told that the orthodoxy is you can take 6 to 7% out of a retiree's portfolio because the equity markets are strong enough that they're going to always allow you to do that. And so he questioned that judgment. He took the Ibbotson data, which started in 1926, and he did exactly what I've just shown you. He built rolling portfolios. He did one portfolio that starts in 1926 and goes to 1955. The next portfolio started in 1927 and went to 1956. He asked then the question, what is the largest amount that I can take out of this portfolio on the first day of every year and then let the rest of it appreciate by the growth rate that year, okay, and not run out of money over 30 years. Now, he was trying to do as much as he could for real world, and in those days, in the 90s, we still had high enough treasury rates that he could build this series of portfolios that was 50% equity, S&P 500, and 50% 10-year treasury notes. He subsequently did the same analysis by going all the way up to 70% equity and 30% treasury notes, and he still got pretty much the same results, but On the good years, he had much greater portfolio value. But what he found was there was a couple of periods that he ran into problems. And the worst one was in 1966. So what I'm going to do is show you what he found with somebody who retires on the first day of 1966 with $1 million portfolio at that time, and using this 4% rule. So that's the red. So the client retired 1966, they took out $40,000, and then the balance grew by the S&P 500 returns. 1967, he took out another $4,000 plus the inflation rate. Now you have to remember, in the late 60s, especially in the later 1970s, inflation grew dramatically. So what's going to happen is this convergence, and you can see this after 10 years, you see this red line start to go down quite a bit. And we had really pretty much a flat market in the 1970s. So you had two bad things happening: a flat market and high inflation. So you're taking out more and more, and you're not growing the balance of the portfolio. Up to this point, that by the early 1980s, the withdrawal rate from the portfolio started to exceed 10%. So even though we got really strong returns in the late 80s through the 90s, there wasn't enough in the portfolio to hold up to the withdrawals that were coming out every year. Ironically, somebody who retired the very next year, on day one of 1967, just 1 year later, not much different on all the computations, their portfolio ended up doing just fine over time. It just takes this magic period of 1 year if you don't change the withdrawal rates at all. Now, when you reduce the initial withdrawal rate to 3.8%, then that horrible portfolio in 66 lasted not 27 years, but it lasted for 32 years. But if I raised that initial withdrawal rate to 4.2% on day one, then I reduced the portfolio life to only 24 years. So you can see just how sensitive we run into this problem. We'll talk later about, in another lecture, about strategies that can alter the withdrawals. You need to understand that for your clients. So, when does sequence of return risk become a real issue? Well, Wade Pfau and Michael Kitces has talked about the effect of sequence of return risk and withdrawals. And what they found is that there's a very condensed period when it becomes really important. And that is this period from 5 to 10 years prior to retirement, and for the 10 to 15 years after retirement. Think about it with respect to just absolute portfolio size. That's when the portfolio is at its largest. So if I have two portfolios, one worth $1 million and one worth $100,000, if the $100,000 portfolio loses 10%, that's only $10,000. But if the $1 million portfolio loses 10%, that's $100,000. So you can see there's a big difference in absolute dollars, especially when we're withdrawing money out of the portfolio each year. So what they worry about is when the portfolio is hitting that peak point. Now you've learned to calculate how much money, based on given assumptions, does my client need to have on day one of retirement. And as you're getting closer to that period, what Pfau and Kitces advises, if your portfolio value is already in excess of what the client needs on day one, you need to start taking risk off the table pretty dramatically so that you reduce any of the risks of this sequential effect for 2-3 years, taking out an awful lot of the value of the portfolio. The same thing holds when the client starts to actually withdraw money from the portfolio, because there really isn't any strong recovery at that point. So you want to have your minimal amount of risk. Now, the irony is that over time, as your client's retirement period grows longer and longer, you want to actually increase the amount of risk, because the effect of the sequential return risk starts to shrink. As the portfolio value shrinks, so does the effect of the sequential return risk. So you can actually take more and more risk. And the way you do that is by taking money out of the very low portion of the portfolio and let the equity portion rise. In essence, what they're advising is that you let time work for you. And that's the whole key to this sequential of return risk, is that over time, equity portfolios do grow. But if you don't give it time, you run into problems.